Howdy, investors. This is Darius Dell here, founder and CEO of 42 Macro. And today I'm going to talk to you about our discretionary risk management overlay, aka Dr. Mo, which is the systematic system that we use to help our professional investor clients and sophisticated retail trader clients stay on the right side of market risk, which means maximizing upside capture in bull markets and minimizing downside capture in bear markets. So we'll start with our 42 Macro risk management process. The number one thing that we do for our clients here at 42 Macro is to help them identify and position for the market regime. We don't help them identify and fight the market regime. We want them to participate in what the markets are trying to price in, because that's ultimately how you make the most money in bull markets and minimize downside capture in bear markets. And so how do we do that? We now cast the market regime with our global macro risk matrix system, which we'll talk about shortly. And then we filter those signals through our KISS portfolio construction process, of which we have thousands of retail investors around the world following that simple 3 ETF solution to stay on the right side of market risk. And then our discretionary risk management overlay, which takes those same market regime signals and generates proper trade recommendations across 70 different factors across the equity, fixed income, commodity, currency, and crypto markets. And so when we say, so for those who may be new, what is a market regime? Well, if you go back and you study some of the kind of hallowed halls of institutional finance, what you'll find is that a lot of the best firms do from an asset management standpoint is use regime segmentation to orient their factor long short bets. And so generally speaking, there's about 4 different regimes. Goldilocks is a risk-on regime in which investors, it's a risk-on regime with a disinflationary bias in terms of the performance in asset markets. Reflation is a risk-on regime with an inflationary bias in terms of the performance and dispersion within and across asset markets. Inflation is a risk-off regime with an inflationary bias in terms of the dispersion within and across asset markets. And then deflation is a risk-off regime with a disinflationary bias in terms of the performance and dispersion across asset markets. And so generally speaking, in a risk-off regime, you're going to want to be long overweight risk assets and underweight defensive assets. In a risk-off regime, you're going to want to be doing the opposite. Generally speaking, in a risk-on regime, you're going to be overweight high beta as opposed to an underweight low beta. And the opposite is true in risk-off regimes. From a sector standpoint, you're going to be overweight cyclicals and underweight defensives in a risk-on regime, as opposed to the opposite is true in risk-off regimes. Generally speaking, growth tends to outperform value in risk-on regimes, whereas value tends to outperform growth in inflation, and growth tends to outperform value in deflation. In terms of market cap bias, your factor long short preferences, you're going to be overweight small and mid caps in a risk on regime and underweight large caps. And then the opposite is true when you're in a risk off regime. From a regional standpoint, US tends to outperform international in Goldilocks, whereas international tends to outperform the US in reflation. And then the US tends to outperform both in inflation and deflation. US tends to outperform in both inflation and deflation. EM tends to outperform DM when you're in a risk-on regime, and the opposite is true in a risk-off regime. When you're in fixed income, spread products tend to outperform treasuries in a risk-on regime, whereas the opposite is true in a risk-off regime. When you're in thinking about allocating across the treasury curve, the short end of the curve tends to outperform the belly of the curve, which tends to outperform the long bond when you're in a risk-on regime. The opposite is true in a deflation regime. And then when you're in an inflation, and so that is true across Goldilocks, reflation, and inflation in terms of short rates outperforming the belly, which tends to outperform the long bond. That is true in again, Goldilocks, reflation, and inflation, whereas in deflation, the performance is reversed. The long bond tends to outperform the belly, which tends to outperform short rates. With respect to credit, if you're in a risk-on regime, high yield tends to outperform investment grade. And if you're in a risk-off regime, investment grade tends to outperform high yield. In commodities, industrial commodities tend to outperform energy commodities, which tend to outperform ag commodities in a risk-on regime. The opposite is true in a risk-off regime. And then finally, with respect to currencies, gold tends to outperform foreign currencies, which tend to outperform the US dollar. In risk-on regimes, the US dollar tends to outperform gold, which tends to outperform foreign currencies and inflation. And then gold tends to outperform the US dollar, which tends to outperform foreign currencies in deflation. And so what regime segmentation does is it makes the process of asset allocation and portfolio construction much simpler, much easier to think about, and ultimately it creates better outcomes in your portfolio when you're generally participating again in what the market is trying to price in when the market is trying to price it in. And so let's talk about how we determine what the actual market regime is and how we send out timely and actionable signals for our clients to actually reorient their portfolios on time so that they can continue maximizing upside capture in bull markets and minimizing downside capture in bear markets. And so we use our global macro risk matrix to now cast the market regime, which investors must position for to avoid FOMO or FOML. Fear of missing out causes investors to buy cycle tops, and fear of more losses causes investors to sell cycle lows. And so how does this system work? What we're looking at here in this table are 42 of the most important markets, market prices, macro markets in the world from the perspective of the institutional investor community across equities, volatility, commodities, currencies, and then fixed income across credit and sovereign debt. And so how does the system work? We use a couple of examples here. So we'll start with the S&P 500. Today, it is bearish from the perspective of its own individual volatility adjusted momentum signal, which is how we measure volatility or how we measure momentum in and across asset markets. And so that bearish VAMS signal for the S&P 500 today is attributing 1 point to each of the two risk-off regimes, inflation and deflation. For example, the 10-year Treasury yield broke down to bearish today. And historically, the 10-year Treasury yield has had a negative absolute performance in Goldilocks and deflation. So each of those regimes is currently getting a point. And then finally, looking at something like gold, gold is bullish from the perspective of its volatility, just a momentum signal. So gold has historically performed well in every regime with the exception of inflation. So gold is getting the Goldilocks is getting a point, inflation is getting a point, and deflation is getting a point. And so how we determine the market regime, we're just looking at any given time which of these four regimes has the highest sum and share of confirming markets. And right now, it's inflation. Inflation having 19 of the confirming markets. And what we mean by confirming markets are the ones that are actually generating a bullish or bearish signal. The neutral signals don't count because there's no conviction in that trade for that particular macro market exposure. And so, what we say is if we're in an inflation market regime, then you're going to want to orient your portfolio to take advantage of the things that tend to happen when you're in inflation market regimes, at least according to our back testing and the generally accepted belief system across institutional finance. In terms of the regime change statistics, so generally speaking, there's about 1.5 to 2 what we call roll phase transitions per year. What a roll phase transition means is just that you're going from a risk-on regime to a risk-off regime. And as we showed here in this slide, the factor long-short preferences, where you're going from risk-on regime to risk-on regime, don't really change that much. And the factor long-short preferences, when you're going from the two risk-off regimes, when you're transitioning between the two risk-off regimes, don't really change that much. It's when you go from risk-on to risk-off or risk-off to risk-on where you have to make significant changes in your portfolio if you want to remain on the right side of market risk. You don't have to remain on the right side of market risk, but I can guarantee you if you're a professional investor managing other people's money, if you choose to not remain on the right side of market risk for a long enough period of time, you won't have anybody else's money to manage. And so obviously what the system does is it keeps our buy side clients constantly oriented towards what the markets are trying to price in, so they can get back to understanding what their company fundamentals are, what their credit fundamentals are for the credits that they're investing in, et cetera. So as I mentioned, there's about let's call it 2 row phase transitions per year, which is where you have this most significant amount of change in your portfolio from a portfolio construction and asset allocation standpoint. So if you're in a bull market, what you tend to see is you have 1 row phase transition to a deep enough correction that warrants risk managing as a buy side professional, and then you have another row phase transition back to the bull market. If you're in a bear market, what that ultimately looks like is you have a big enough counter trend rally in a bear market that ultimately is big enough for institutional investors to have to risk manage in order to essentially stay in their seats if they're buy side professional. And then there's another row phase transition back to the bear market. And so what Dr. Mo does, what Dr. Mo does is takes that information from a market regime nowcasting standpoint and filters those signals across 70 different factors across U.S. equities, U.S. equity factors, global equities, fixed income sectors, and macro exposures, which we interpret to be commodities, currencies, and crypto. And it generates proper trade recommendations based on the combination of the market regime as well as the combination of the individual assets volatility adjusted momentum signal. So for example, if an ETF is bullish or bearish VAMs, let's just start with the bullish because it's easier to explain this way. If an ETF is bullish or if a factor is bullish, and it should be bullish in this regime, then Dr. Mo will recommend a long max position in that particular exposure. Again, this is a market timing and position sizing guide for factor long short bets. If an asset is neutral, but it should be bullish in the particular market regime that we're currently in, then Dr. Mo will recommend a long half position in that particular asset. If an asset is neutral and it should be bearish based on how it's historically traded, based on our back testing here, how it's historically traded in the particular regime, then Dr. Mo will recommend a short half position. And then finally, if an asset is bearish, and it should be bearish in the particular regime, then Dr. Mo will recommend a short max position. And then finally, for the assets where they are bullish, but they should be bearish in this regime based on the historical backtesting, or if the asset is bullish and it should be, or so bullish and it should be bearish, or if the asset is bearish and it should be bullish, then Dr. Mo will say, hey, do nothing. The market is sending conflicting signals. Your capital will be rewarded elsewhere for the time being, and so it'll recommend a no position in those particular assets. So let's use a few stylized examples so we can sort of hammer home the how easy and effective this system is, and why our buy side clients continue to rave about the results that they're experiencing in their client portfolios as a function of adhering to these signals. So let's use the S&P 500. Everyone cares about that. So right now, the S&P 500 is bearish from the perspective of its volatility adjusted momentum signal, but historically, S&P has performed quite well in a Goldilocks regime. So if we were in a Goldilocks regime, which we're not currently in this on March 24th, 2025, we're actually in an inflation market regime, which we'll get to in a second. If we were in a Goldilocks market regime, Dr. Mo would recommend a no position in stocks. Let's keep it moving here. Let's look at the long bond. In a Goldilocks regime, right now, the long bond is neutral from the perspective of its own volatility adjusted momentum signal. And historically speaking, the long bond has had negative absolute performance in this Goldilocks regime. So Dr. Mo is recommending a short half position in the long bond. If currently gold, for example, is bullish from the perspective of its volatility adjusted momentum signal, and historically has done really well in Goldilocks. And so right now, Dr. Mo is recommending a long max position in gold. And then wrapping up with Bitcoin, Bitcoin is currently neutral from the perspective of its volatility, just a momentum signal. And so it's historically obviously performed quite well in Goldilocks. And so right now, Dr. Mo is saying, hey, you could be long a half position in Bitcoin as opposed to a long max position like it has in gold, which is currently still bullish from the perspective of its own volatility, just a momentum signal. And then, as I mentioned earlier, the factor long short preferences that you're going to want to sort of take into consideration when you're constructing your portfolios are listed down here at the end of the page. So in terms of what the key portfolio construction considerations are, which again is this essentially a summary of the information that we put in this table here on the right here on slide 13. So let's keep moving here. If we were in a reflation market regime, then the S&P's bearish VAM signal will continue to signal no position. The Treasury's neutral VAM signal will continue to signal short half position. The gold's bullish VAM signal will continue to signal a long max position, and Bitcoin's neutral VAM signal will continue to signal a long half position. When we go into a risk off regime, so transitioning to an inflation regime, which is our current regime for the current juncture for Monday, March 24th, 2025, the bearish VAM signal for the S&P 500 is currently a short max position as it would be in an inflation regime. Again, the S&P is currently bearish from the perspective of its own volatility, just a momentum signal condition, and the market regime condition is risk off. And so those two things formulate the short max position signal that Dr. Mo is currently recommending for the S&P 500. If you look at treasuries, treasuries have historically performed poorly in the treasury bond. The long bond has historically performed poorly in inflation. So Dr. Mo is recommending a short half position still there. If you look at gold, gold has historically performed poorly in an inflation market regime. And so despite it being bullish VAMs, it's currently recommending no position because, again, gold has historically performed poorly. And so that dichotomy between gold's current VAMs condition and the market regime is essentially telling you do nothing, walk away, don't waste your time or energy trying to focusing on this. And same with Bitcoin. Bitcoin is currently neutral. And then finally, if the market regime were deflation, historically S&P 500 has had reasonable enough performance in deflation. So this bearish VAMs condition is currently recommending a no position in gold in the S&P 500. If we were in a deflation market regime, this neutral VAMs signal for the TLT would be a long half position. In gold, this bullish VAM signal for gold would be a long max position in a deflation regime. And then finally in Bitcoin, it would be a no position in this regime. And so, as I mentioned, at any given time, our clients currently are aware of what the market regime is. And so we refresh the Dr. Mo model for that particular market regime. So until we change market regimes, then our clients will consistently see the market regime. As I mentioned, we're currently in an inflation market regime here for Monday, March 24th, 2025. And so until that market regime condition changes, our clients are going to be orienting their portfolio from a portfolio construction consideration perspective, and ultimately adhering to the proper trade recommendations that are designed to take advantage of the market risk provided by the inflation market regime. Again, it's not about hoping that we go into a Goldilocks or reflation market regime or hoping that we transition to a deflation market regime. What Dr. Mo says, don't worry about that. That'll come in the future. For now, take advantage of the market risk that the returns that the market are trying to give you if you're paying attention. You don't have to pay attention. You don't have to stay on the right side of market risk. But as I mentioned, if you stay on the wrong side of market risk for a long enough time as a professional investor, you're not going to have anybody else's money to manage. So ultimately, what we found throughout our travels across the global buy side and our clients, we currently advised well over $25 trillion in client AUM. What we found is that, essentially so much of the job for most buy-siders has become to orienting their portfolios to take advantage of what the market's pricing in. Not enough investors on the buy side anymore have enough time horizon or duration to just invest in the companies and the credits that they ultimately believe in the most. And so, so part of the job, what we've built this system is to help acknowledge that and ultimately take advantage of that. And it works really, it's incredibly effective. And so, as you know, we backtest everything very rigorously with institutional grade backtests here, and with respect to all of our signals, Dr. Mo included. And so, if you wanted to isolate some of the key macro kind of factors, the macro markets that matter to most investors, what we find is that our Dr. Mo signals are incredibly effective at, again, helping investors stay on the right side of market risk, which it means maximizing upside capture in bull markets and minimizing downside capture in bear markets. And so, in terms of how to interpret these charts, what this the bars in these charts just identify the cumulative performance by proper trade recommendation. So this is the total amount of performance you would have achieved just being long these assets since January of 1998 in terms of in terms of summing the daily log price changes for each of these assets. And then what the dotted lines indicate is the percentage of that cumulative performance that has occurred during as a function of each of these proper trade recommendations. And so what we ultimately see is that when Dr. Mo is recommending a long position for the S&P 500, historically, the 110% of the return, the cumulative performance that we've seen in the S&P 500 since January of 1998 has come when Dr. Mo has recommended a long position in the S&P 500. And so, for example, what does that mean? So if the S&P 500 was up 100%, since January of 1998, it's up somewhere closer to 300, 400%. But if it was up just stylistically, if it was up 100%, you would have made 110%. If there was $1 to be made, you would have actually made $1.10 just by being long the S&P 500 when Dr. Mo tells you to be long, and not being participating in the asset when Dr. Mo tells you not to participate. And the reason that's incredibly important for institutional investors is because when you're long an asset, when you're supposed to be long an asset based on its volatility, just a momentum signal characteristics and the market regime signal characteristics, you tend to have lower volatility, lower drawdowns when you're in those moments. And so ultimately your risk adjusted returns increase when you're participating in the asset when you're supposed to be participating, and not participating in the asset when you're not supposed to be participating, when the volatility of the asset is higher, when the drawdowns are steeper, and ultimately your risk adjusted returns are lower in those assets. For global equities, 140% of the cumulative performance since January of 1998 has come when Dr. Mo is recommending a long position. So for instance, if there was $1 to be made just being naked long, buy and hold global equities since January of 1998, you would have made $1.40 if you were only long them when Dr. Mo says be long. That upside capture ratio is 105% for the long bond. It's 114% for international bonds. It's 103% for investment grade credit. It's 116% for high yield credit. It's 1,700% essentially for the dollar, which, by the way, the dollar doesn't have much cumulative performance because it's a stationary object over long enough time horizon. So obviously those results are a bit skewed, but again, it continues to signal that if you're long when you're supposed to be long, particularly for an asset that has a high degree of mean reversion like a currency would, then you're actually improving your risk adjusted returns by even that much more. The upside capture ratio for gold is 94%. The upside capture ratio for commodities is 240%. It's 158% for crude oil. And then finally, for the crypto market, the upside capture ratio for Bitcoin is 108% and 150% for Ethereum. So what that means is that if you're long Bitcoin, when Dr. Mo tells you to be long Bitcoin, you would have made $1.08 as opposed to the dollar you could have made if you were just naked long, buy and hold Bitcoin, which is what the bull porn purveyors would have you do. And the issue with the bull porn out there in the crypto space is crypto has much more significant drawdowns than most asset classes. I want to say Bitcoin specifically has declined about 75 to 90% once every 4 years since the inception of the asset class. And so obviously that may not matter to you if you're 25 or 30 something years old and you don't have that much money you've accumulated over the course of your career in your portfolio. But if you're in your 50s or 60s, or heaven forbid you're retired, you can afford to suffer a 75 to 90% drawdown in a core strategic holding. And so ultimately you need systems like Dr. Mo to keep you on the right side of market risk, which means be long when you're supposed to be long and don't be long or be short when you're supposed to be short. And so just be aware of that. And again, that upside capture ratio is even better for Ethereum since the inception of that asset class at 150%. So you would have made a buck 50 being long Ethereum as opposed to the dollar you could have made since Ethereum was first launched. So that's our Dr. Mo system. Again, it's an incredibly effective system. It sends out clear, actionable, and timely proper trade recommendations based on the market regime that we're currently now casting ourselves in, and ultimately how the asset is currently performing from the perspective of its volatility, just a momentum signal. And what this does is it adds a very institutional grade risk management overlay to the factor long short bets that our professional investor clients and sophisticated retail trader clients are making. And that's why they continue to have superior results relative to their competitors. So we'll wrap it up there. Darius Dale here. Thanks for joining us.